Thank you so much for joining us, Mr.
You're
Duggal.
welcome.
Truly a pleasure having you on ET Now. You've gone through some tough times just like everybody else. First demonetization, GST, and of course, the rise of unruly competition. How are you saying you're recovering post-GST?
Well, the demand has picked up, and
You're saying the demand has picked up to pre-GST levels?
Even better than that, because even pre-GST, we've had a pretty poor growth pattern as an industry since 2014. And we were seeing the beginning of revival of demand in around September, October of last year, which then was quickly decimated by demonetization.
Sure.
And then, of course, we had a mild recovery in the fourth quarter. Then again, you had the GST come in, so we had a poor first quarter. Now, with those headwinds now being to some extent mitigated, in fact substantially mitigated, we are seeing restocking happening, and we're also seeing end demand perking up, which is actually the most important thing. But once again, I would caution that we cannot take the sustainability of this demand as a given. There are a couple of headwinds which are coming in. One is, of course, the monsoon is not really as good as what was envisaged even a month ago. The dispersion is poor. You have pockets of excess rain and flooding, and then you have droughts in the others. So it's a pretty average, or perhaps even a below average monsoon, and that's something which we have to take cognizance of. The second thing is that there is a fair amount of distress, as we all know, in terms of the unorganized sector, which provides most of the employment. And if the agri output is also pretty muted, that is a fairly toxic combination which can compress demand. So we have to be a little bit careful before we say that we are completely out of the woods and the demand going forward would be very resilient. So therefore, even if the demand is not very strong, we'll have to look at other levers of growth like market share improvements, et cetera, leveraging our Ayurvedic heritage, for example, which is a very important part of our future strategy. We'll find ways to deliver, I think, better performance. The last 2 years have been very turbulent, and we are pretty confident that the future would be much better than what it has been.
How has that rural story panned out? The bets on rural, let's say 5 years ago, were pretty significant.
Yeah.
Everybody was going all guns blazing, thinking that the story will emerge, but I don't think it's really delivered.
True. I think the rural story has been a bit of a disappointment since 2014.
Sure.
It was pretty robust before that for around 8 to 10 years, and we got a lot of our growth from rural. It suddenly tapered down. Having said that, I do see rural growth reviving going forward.
Why?
A, it's a low base, and B, there is a growth in terms of real disposable incomes, which will get into the consumption space, and particularly staples consumption. Now, whether the demand will get into those strong double-digit levels which we saw in 2007 to 2012, I don't know. But there's every likelihood that it will be much ahead of what we saw in the previous 3 years. So therefore, I think we have to not just look at the inherent demand, we also have to look at delivering a better value proposition and improving share, taking something away from our competitors to really drive growth into those strong double-digit numbers which we all seek.
Sure. I want to talk to you about categories where you've had to face heavier taxation because of GST, but you have not yet increased prices, so to speak.
We are doing so as we speak. We have just in the last few days increased the prices of some of our skincare products, Gulabari for example, and some home care like Odonil. These were the two areas, skincare and home care, which were negatively impacted by GST. Rates went up from around 22, 23 to 28. So there has been an element of higher tax. In addition to that, there's been some inflation also which has kicked in. But these price increases are mild. They're really to mitigate the negative impacts of GST and inflation. And they will not result in hugely expensive products on the ground. I don't think we'll be increasing prices beyond 2%. So even though there are signs of inflation coming back, we've seen around 4.5% WPI, fortunately our basket is not very negatively affected. We don't want to derail the consumption story by taking sharp price increases. At this point in time, it is very, very important for us and for all companies to rebuild the top line, restore consumer confidence in terms of pricing stability, and only then we will have the platform to take up prices perhaps early next year.
Mr. Duggal, a lot of FMCG majors, have said that their last mile stockists are finding it extremely difficult to cope in the new regime. What is your view on that? And apparently they're finding it so difficult to cope that they're quitting the trade altogether. What is your view on that, and have you also had such concerns?
In our experience, it's really not the last mile stockists which are suffering because of GST, it is really the wholesaler. because we did undergo a very extensive plan of training and giving them the software, putting in some hardware, etc., making sure that they are GST compliant. In any case, they were VAT compliant, so they were a fairly compliant bunch of entities as far as our distributors are concerned. Now, the wholesale is where the compliance levels were always low, and they are struggling now to deal with this whole compliance infrastructure and requirements. So that is where the problems really are centered across. And this is what we call the GT wholesale, general trade wholesale, which is around 25% of our business. So it's a big chunk, and even more so in the northern and eastern parts of the country. Now, what we are doing is we are, in a sense, bypassing this channel, going to these super stockist and sub-stockist networks, which we've built over the years, which today are around 20% of the total business. And I suspect there will be a sharp trade-off in terms of where our sales happen, away from wholesale and towards the super stockist. And this is really the rural feeders. And this change is already happening. Whether wholesale will rebalance and get back its earlier pole position, or whether it will cede ground to the super stockists, we do not know. But fortunately for us, our stockist infrastructure has been very resilient. And I attribute it to the amount of effort we put in, the amount of investment we put in making sure that they were able to navigate the GST hassles, and they were able to comply with whatever the GST framework is.
I'm glad you brought up distribution channels, because, again, over the last 5 years, one has had many discussions, and there have been a lot of emphasis given to especially e-com, and before that, of course, modern trade. But today, if I had to ask you, when you look at your split, e-com versus modern versus mom and pop, have you seen significant growth in terms of traction from e-com that will make you think that it's going to be changing the entire dynamic story in the next 5 years?
That's a question which I don't have a real answer. One thing is certainty that e-com is going to be the fastest growing channel.
Because the base is low.
Yeah, the base is low, and the investments which are being put in by entities like Amazon and Big Basket are pretty significant. And that's part of a long-term strategy which will yield results later. And I think we have to ride with that trend. We have to partner with the e-commerce entities, and how big it ultimately comes to, it's very hard to say, but it could be, let's say in the next 5 years, maybe close to 10% of our business. If not in the next 5, maybe in the next 7 to 8 years, 10% of the total sales could be from e-com. Now that may look a big stretch, because at the moment it's 2, but things are changing very quickly.
And how about modern trade?
Modern trade will grow ahead of traditional trade. Now, the trajectory of growth, it's always been, say, around 2x of traditional trade for us over the last 5 years. Whether this 2x will become 3 or 4, I don't know, but I think it will accelerate. So basically, e-com is going to be the fastest channel, followed by modern retail, both B2B and B2C, particularly B2C. Particularly B2B. And then the traditional trade is going to start declining, but declining in an orderly manner. This is not going to be disruptive decline. And that's very good, because there's so many people employed by traditional trade. We don't want any dramatic changes here, which will then impact consumption, also will not be good in terms of overall economic growth.
Right. In terms of the way you are consolidating your warehouses to drive synergies, what is the kind of action we'll see from your distribution stable?
One is, this is a cost mitigation exercise. Why have a depot in West UP and another warehouse in Delhi? You can feed, say, Delhi from the West UP warehouse. Why have a warehouse in Chandigarh, which we had to in the earlier days because of the CST issues. So this is really the obvious ones, and which we already, like I said, shut down half a dozen warehouses, and perhaps more will be done. But ultimately, the rationale for warehousing and channel networks is to provide optimal service levels. Because in a high margin business like ours, lost sale is really what you really don't want to happen. You can live with higher inventories, you can live with supply chain efficiencies, you cannot live with lost sales. And service levels is a proxy for lost sales. So you have to raise service levels to that 90-95%, which is what the trade desires. And the network will have to be adapted to deliver those service levels.
Mr. Duggal, it has been stated that, by Dabur, that it would make more sense to understand market sentiment, understand consumer demand, and see if the consumer sentiment is buoyant enough to actually go into strategic new launches. And until then, keep it at hold. What is your reading right now of the market, market demand, and of course the sentiment? And do you think it might be wise to put off, launches until, let's say, everybody stabilizes
until the dust is settled? No, I don't agree with that. I think we have been very conservative in launching new products in the last year and a half on the back of very subdued demand, and then of course the disruptions which happened. In our case, at least, we are going to be very aggressive in new product launches.
Okay.
I think, but we'll go with the lower hanging fruit first, the easier ones to go to market, the ones with least level of risk, etc. We've already launched 5 so far. I mean, that's quite a large number, more than what we have done in the past 1.5 years. And the pipeline is pretty much primed to launch many more products in the quarters ahead. So we are going to be very aggressive on new products. We're also going to be investing substantially in terms of media and advertisements to fuel the new product growth, as well as to further intensify investments in our existing products.
So how much are you looking at boosting your ad spends by?
This year, of course, Q1 was very subdued because there was no point advertising in that scenario. I think Q2 onwards, the ATL spends, the media spends, would perhaps go by around 50 to 20%. Okay. I'm talking about the 3 quarters, the balance 3 quarters of the year.
Right.
And for the full year, they would probably trend at around 10 to 12%.
Okay.
But there would be some reduction in the promotional part. So some of the additional spends would be met out of savings from promotions, because we are moving spends from below to above the line as part of the long-term strategy.
Mr. Duggal, can't help but talk about the Patanjali impact across all categories, especially oral care, and of course a few other key segments. Do you feel the market is big enough to accommodate everybody? Because if you just look at volumes, they spin a different tale.
Patanjali is a very interesting reference, because the Patanjali impact really happened when the consumption stress was at the highest. So obviously, whatever share they took over from other players, including us. The impact would have been far less had the categories' growths been reasonably good as what they are today. Because the market size is so big, it can accommodate not just one but many Patanjalis. The other positive aspect of Patanjali is it's unveiled the fact that there is a far larger market for Ayurvedic products and traditional Indian products than perhaps was envisaged earlier.
Yeah.
So there's a lot of category expansion which has been done, and a lot of recruitment which has been done from both non-users as well as users of the regular products into Ayurveda. And I think that augurs very well for us, because the recruitment is very hard. And so therefore we can gain out of that. We see a bright future post the expansion of the whole Ayurvedic space for companies like ours. Perhaps nobody is better positioned to take advantage of that.
Mr. Duggal, you've been one of the longest standing CEOs in the FMCG space. So you've seen a lot of players come and go. However, having said that, you must agree that we live in very different times today. So for instance, you also have competition. You've always had competition and severe competition, but you've never had unruly competition. And with the emergence of homegrown unruly competition, where they are not followed by any communication diktats or rules or procedures, and companies such as yours and others have some protocols to follow, don't you think that some way leaves you a bit disadvantaged, because you're not designed to communicate, whether it is to the consumers or via your ads or to the media, in this guerrilla warfare of communication. So do you think maybe it is time, and I don't know, I'm just speaking out, to internalize for companies such as yours and many others who are today subject to such attacks, to change the way you communicate?
No, we will not change the tonality. We will not do what other people are doing. But fortunately for us, there is a legal framework here. And if somebody is crossing the line in terms of communication,
and you will move the court.
We move the courts, and we've done it. Not just us, but many other companies.
I agree, but don't you think the damage is done? You can move the court, and you can win the case, and the ads may be withdrawn. But don't you think at some level that basic communication which has hit the consumer, the message has been delivered?
My own experience in 30 years of marketing is that if the tonality of the communication is wrong, the consumer does not buy into it. In fact, that is a negative impact in terms of the brand performance. We've never indulged in that, and it's not that because of any holier than thou attitude, but simply in India, very harsh competitive advertisements tend not to work, especially when there's no substance behind it. Now, somebody can say, I'm cheaper than yours, and that can strike a chord, because that's a very clear. But if somebody says that you are wrong because of reasons which the consumer cannot decipher, that communication doesn't work. But at the same time, I think to send a message, we do make sure that the communication is not aired, because it's outside the framework of the law. Even if we let it run, quite frankly, it won't damage us.
In terms of your international business, about 30% of your business comes from international markets. So, but we've seen some pain points there as well. We've heard that a lot of players who are also present in the Middle East market have claimed that they see the Middle East market bottoming out. Is that your experience and your view too?
Yes, there's still pockets of pain, but the key market, which is Saudi Arabia, which is half of the MENA consumption, or at least the Gulf consumption, is now bottoming out for sure and is now on a recovery path. How strong the recovery is still remains to be seen, but definitely we saw the bottom perhaps in the last quarter or the quarter before that. In other markets, our problems were largely on account of currency, not on account of the underlying demand.
Yeah.
For example, Egypt, which is perhaps our second biggest market overseas, we've seen growth in the region of 30-35%, but all of it in the Egyptian pound, which has depreciated by half vis-a-vis the Indian rupee or the dollar. So therefore, whatever you gain in terms of local growth, you lose in terms of translation. The good thing is that we are beginning now to anniversarize the devaluation of many of the currencies, the Turkish lira, Egyptian pound, Nigerian naira, etc., etc. And if the currencies remain stable now, which they show every signs of doing, then we should see strong growth coming back from the third quarter and definitely from the fourth quarter, because the currency devaluation would be anniversarized. But there will be still some damage in terms of margins, which we can rebuild over the next 1 or 2 years.
Okay.
So I think the international business, which perhaps was even more impacted than the domestic business because of macros, you can't do anything about currency devaluations, you just got to ride them out, has now begun the growth phase. Certainly from the third quarter you would see growth, and I suspect the growth in international business would be even stronger than that of the domestic.
If I may ask you, what are your three biggest markets, 1, 2, 3 in that order in when we talk of your international business?
Well, if you take inorganic and organic, then the US would be our biggest market, followed by now Egypt in the local currency, and Turkey and Saudi Arabia almost neck to neck.
Are your margins better in your international business than your domestic?
At this point in time, no. They are marginally lower than the domestic business, but structurally they're higher.
They should be.
And I think next year they will once again be higher than the domestic business.
So, would it be a focus to then increase substantially your international play and make this 70-30 skew change in the coming years?
I'll tell you how we design our domestic and international strategies. The two businesses are substantially siloed. Only a few people like me oversee the entire global business. Otherwise, operationally, they're very independent. Financially, we don't move a single rupee of money from India overseas. And that's been something which we have hardwired as part of our DNA over the last 20 years. So the international business will grow on the back of its own momentum, its own free cash flows, and its own strategies. And we will, of course, encourage them and guide them in that process, but don't ask us for money, don't ask India for money. That's a caveat which we have, and they respect that. So therefore, they will grow according to their own resourcing, and I think that is the way they should, because you have to sort of sink and swim. So, and there are smart enough people there to have a growth which would be substantial. Whether it will be ahead of the India business depends upon the level of M&A activity which happens. Because M&A opportunities are obviously far more overseas than in India.
Sure.
At the same time, the risk associated with M&A is far higher overseas as compared to India. So both India and overseas will pursue M&A opportunities, and perhaps the growth rate would be higher or lower depending upon the outcome of those initiatives.
You don't have ambitions of Dabur becoming, this international brand?
No, it will become a brand which is in select geographies.
Okay.
So it won't be known from Argentina to Australia.
Sure.
But in the MENA region, in the greater MENA region, which includes Turkey, in sub-Saharan Africa, in the SAARC areas, and perhaps in East Asia, we should be a household name. That's very important. But we are not a developed market entity, and we don't have any ambitions to become one. Maybe that will happen many years in the future, but not in the near-term horizon.
Would I be right to assume that Africa, in your international play, will be your biggest focus, given that you've just finished 2 acquisitions, which are pretty significant? And if we just look at your acquisitions and your current business play, going forward, it looks like it should show as much potential as the North American market.
Well, Africa, obviously the headroom is huge. That's why everybody has gone to Africa, because the consumption intensity is so low and the potential for growth is so high that it's a very attractive price. But I think most companies who have gone into Africa have actually not benefited by that.
That's true.
So you've got to be very careful. And I think our learnings have been that you should invest in Africa, but be very clear-eyed about the investments and be very clear-eyed about the underlying risks of those investments. And keep the ticket size low. Don't spend a fortune in Africa. So I would do small acquisitions with limited downsides and big upsides, rather than buy a company of $500 million there, which could prove very toxic if the macro issues turn against us.
Any new market entries that you're planning?
East Asia, I think. Myanmar is again a big prize, and we are investing in Myanmar. And looking forward, I would not rule out doing business in ASEAN. I think ASEAN has opportunities. It's reasonably aligned with South Asia in terms of consumption habits, unlike the Far East, which is a very different ecosystem. So there are potential there.
Mr. Duggal, you've been the CEO of Dabur since 2002, and one of the big reasons for Dabur's stability and its performance, and almost synonymous with the Dabur staple. Having said that, one is wondering who is going to fill your big shoes when it comes to finding your successor.
Well, somebody having bigger shoes, I suppose. But I think to answer your question, succession is critically important. Perhaps it's the most important part of my job as we speak. It's very important in the context of Dabur to look at internal succession rather than external person being inducted. And we began that process 3 years ago. We put it on a little bit of pause mode so that the headwinds which we saw in the last 2 years could be navigated by me at the helm. Because putting somebody new into this kind of situation may not have been good for the business. We've now resurrected the whole succession process in terms of identification of the people, doing extensive mentoring and grooming of those, putting them into different areas from where they have been working, and then seeing who's the best performer. So it's not that we have a designated successor, we have more than one. And let's say in the next 2 years, we should have complete clarity as to who is the right person for the job. And I'm sure one of those persons would definitely fill my shoes and perhaps enlarge the space which I have created.
Fair enough. Thank you so much. Very enlightening talking to you, Mr. Duggal, and all the very best for Dabur's journey.
Thank you very much. Nice talking to you.